Welcome back to another edition. I just had happen, which I suppose has happened to every podcaster. I recorded a wonderful segment and my mic was turned off. Oh, man. So I'm going to do this again. The problem is I don't have a script. So it's going to be done differently, but there's nobody to witness and there's no evidence of the first time through, so we'll do it again. I'm going to be speaking on something that I have never talked about on the podcast, and it definitely is around the intersection of money and emotions. And let's see if you can identify any of the ads. I'm going to read 3 ads. And I'm hearing these a lot. I watch a lot of news, cable news, television, especially on Sundays. And I listen to talk radio when I'm driving or maybe first thing in the morning. And I'm hearing these ads a lot. One of them goes like this. Are you worried about the value of the dollar plummeting? Protect your wealth and safeguard your financial future by investing in gold. Don't gamble with your finances. Choose the proven safeguard of gold. All right. Here's another one. Are you ready to level up your investments? Don't settle for the same old stocks and bonds. Invest in the timeless beauty and value of gold. Don't wait. Buy gold today and join the ranks of the elite. Or how about this one? The fate of the U.S. dollar, it's uncertain. And with ballooning debt levels and a struggling economy, experts warn that a collapse could be imminent. Protect yourself and your family by investing in gold, the ultimate hedge against economic instability. Don't wait until it's too late. Secure your future with gold today. It's like I said, it's hard not to be just inundated by these dire warnings of the imminent collapse of the U.S. economy and the dollar. And I might say that all of these ads were written before 2020. And so it's the same regurgitation. It's the same message that, quite frankly, has been around, I would say, at least for 40 years. And the interesting thing is that these ads must be hitting home, because the inquiries I've had around wondering if I should sell out of a diversified portfolio and go to gold might be a good idea. Well, the answer to that is yes, it'd be a great idea. If the U.S. economy is going to collapse, the value of U.S. businesses and real estate will become worthless, then going to gold is a great move. The question is, how can we honestly assess the probability of the economy collapsing? I wrote this as a quote from my blog. The last few years have tempted investors to take part in a modern gold rush. The precious metal is thought of as a safe harbor for investment capital during times of economic and political unrest and chaos. Now, was that something I wrote last month? No. Last year? No. No, I wrote that 10 years ago. And I write something similar to that every few years when the invest in gold or face financial disaster ads, run. Now, what does this have to do with financial therapy or emotions? And so it's almost laughable to ask, isn't it? The primary selling strategy with these ads is not logic or facts. And rarely do ads really count on that. The purveyors of investing in gold are really not selling gold as much as they are selling a solution to the fear that they create, the panic that they create, the anxiety that they bring up within a person. It's the anxiety and fear that I'm not going to be okay, that I'm not going to survive, that I'm not going to have enough to eat, that I'm going to watch the painful erosion of everything that I have worked for in my life. And that the only way from avoiding these difficult emotions is to buy gold. Now, of course, that's not what they're saying, right? But that's definitely what's happening behind the curtain, behind the scenes. The problem with this is we're not getting this information from an unbiased source, right? What is the motivation for the companies that are selling the gold to be giving us the advice that the economy is going to collapse, the dollar is going to go to nothing? Well, their whole purpose is to sell us gold. If they don't sell gold, they don't eat. They have a huge conflict of interest, don't they, when it comes to giving financial advice? This is not financial advice. This is pure sales propaganda. The message is if you don't buy gold, you're not going to eat. And it's in their interest to motivate you to buy gold with any strategy, any manipulation, any exaggeration, or any outright lie that they can produce. Now that puts them in a really, really bad light. And I'm not suggesting everybody that sells gold is a manipulator or dishonest. But certainly the ads that I read at the opening of this episode are appealing to fear and to panic. And this is really important. Like I said, if they don't sell gold, they don't make a profit. They don't stay in business. So this is something that's important for us to look at. You know, in every case, anytime that we see advertisements, we're not looking at unbiased sources. Doesn't matter what it is, you know, if it's clothing, if it's vehicles, if it's deodorant, cosmetics, whatever it is. It's the job of the advertiser to create a desire, to play on emotions, to get to those underlying vulnerabilities that we have to motivate us to buy. Not in every case, but in most cases. So let's try and take a look behind the curtain of fear about the dollar and our economy collapsing, because we are certainly hearing a lot about that today. This is nothing new. So for those of you that are a third my age, half my age, I don't think this is the first time that you've ever had a chance to hear it, but this may be the first time you've ever paid attention to this. There's nothing new under the sun. This is full confession, a hardcore gold bug in my 20s. I completely bought into the notion that paper currency was going to collapse. Financial investments, which were paper, that was back in the day when you could get shares of stock actually tangible, but they were paper, right? They were no good. I followed a bunch of newsletters, by Dr. Gary North, Howard Ruff, the Ruff, R-U-F-F Times. Harry Schultz was back in that day. There was a whole bunch of them that were forecasting the end of paper investments and the end of our currency. Their message was the only play to make to survive was to own gold, Krugerrands, maple leaves, U.S. Gold dollars, pre-1964 silver coins, and real estate. And I was in real estate at that time. And like a lot of people that sell real estate, certainly own real estate, we call them tangible investors. And these are investors that emotionally are drawn to wanting to touch, feel, and see their investments. So gold, silver, diamonds, gemstones, collections, collecting wine, collecting anything, all this would fall into the category of tangible investing. And if you look down below that, you'll see a real need for control. And sometimes there's fear of what we don't understand, sometimes almost always. And many of those don't understand the financial markets or how they work. It's a big black hole. And there's a lot of fear with that. But there's not a lot of fear if I can put a gold coin in front of me on my desk. It's tangible. So I was completely sold and caught up in that. I remember I put $250 into an IRA back during that time. That was as much as you could put in an IRA back then. And man alive, I saw that go nowhere. And nowhere meant it wasn't doubling every year. So I cashed it out and went and bought a Krugerrand with it. So I was a buyer of gold on January 14th, 1980. Why is January 14th, 1980 so specific? Well, that's when the price of gold hit its all-time high at $811 an ounce. I think it was $811. I know it was over $800. And even though it's hit its high, it absolutely was going higher. I mean, we were talking about gold prices of 2, 5, 10, 35,000. We foresaw gold performing almost the way Bitcoin did, 30 years later, 40 years? Yeah, 30 years later. So it was a bargain. I mean, back in those days when I got paid, I converted the part of my paycheck that I could invest into rolls of silver dollars. So I think you get the picture. Now, over the last 43, 44 years since that time, I've become older. I guess that's fortunately. And a little wiser, which is really fortunate. I mean, I waited and I waited and I waited for the U.S. economy to melt down, for the dollar to plummet. It never happened. About the time I thought maybe it was underway, boom, it would turn around. I mean, the dollar, I don't know if it's as strong as it's ever been today, but it's really strong. It's definitely been stronger since the pandemic. It's been predictions of the dollar not being the reserve currency of the world have been circulated for decades. Now, could it happen someday? Yes. Is it going to happen today? No. Over those 43, 44 years, I saw my gold investment go from $800 to $2,016. It did go up 2.5 times. So, I mean, I wasn't wrong, was I? Well, during the same time, $800 adjusted for inflation needed to grow to just over $3,100. Now, the bottom line is my gold went to $2,000. I needed $3,100 to keep even with inflation. So the bottom line, the gold didn't even keep pace with inflation over that 43-year period of time. That was not as advertised. It was at least supposed to keep pace with inflation. And of course, the economy was supposed to tank and the dollar be worth nothing, which would have meant gold would have been far and away the best investment, but it didn't happen. On the other hand, had I taken that $800 and invested it in the S&P 500, which is an index of the 500 largest stocks in the United States, had I invested it in those terrible paper financial investments, it would have grown to $88,853. $88,853. Now that includes reinvesting the dividends, which is only fair because gold doesn't produce any dividends, does it? Yeah, I checked that calculation 3 times. Phenomenal. Wow, right? That's a big price to pay for not sitting with my fear and anxiety, isn't it? Because the solution is, once I get all that anxiety going about that I'm going to be broke, I'm going to be homeless, I'm not going to be able to feed myself, and I go to satisfy and soothe those difficult emotions, rather than sit with them and feel them and become curious about them and curious as to their origins in my life and in my system. That's a big expense, isn't it? I mean, had I known what I know today, a financial therapist could have been the best investment I would have ever made to span the gap between $2,000 and $88,000. I could have spent a lot of money on financial therapy. And that, I'm joking, but that's serious. Really serious. So, well, okay, back to the facts. That's 43 years period of time. How about more recently? Hasn't gold done better? Yeah. It's done better over the past 10 years, which has had a lot of economic trepidation, a lot of political uncertainty, the polarization, well, it depends which side you sit on, whether democracy is eroding. Well, maybe both sides would say democracy is eroding. A $1,000 investment in gold 10 years ago grew to just under $1,500 today. To keep pace with inflation, it would need to have grown to $1,300. So, in the last 10 years, gold has done better than inflation. How about the same investment in stocks? $1,000 in stocks 10 years ago would have grown to $2,500, which is $1,000 more. Not quite 2 times better than gold. So, really, a number of ways that you take a look at it, gold has not lived up to its hype. And those financial investments have done really well. Now, who knows? The next 10 years could be what I would call a commodities decade, where commodities tangible things, oil, sugar, gold, soybeans, things like that, do better than stocks. That was the case in the 70s. Commodities did better than stocks. You never know. And long-term, just focusing on gold and silver has not been a winner. In fact, any way you slice it, investing in gold's been an epic fail. So those that are selling us the gold would suggest that this time things are different, though. You can't look at the past. Look at how terrible the debt situation is. Look how terrible the political unrest is in our country. It's different this time, and you'd better invest in gold. However, if we strip away the difficult emotions around that, and we take a look at some of the facts, some of the data, the high probabilities they're wrong again. And following their advice will be hugely financially harmful to you, just like it was me. Now, having said all that, again, as I opened with, if you're concerned about the collapse of the U.S. economy, it makes sense to own some gold, silver, and cash, right? There's more of a probability if our economy gets in trouble, the banking system gets in trouble, that there'll be a bank holiday, the banks will close, and they'll limit what you can take out of your account. This happened not too long ago, too many years ago in Cyprus. And they'll limit you to, I don't know, $200 a day or something to withdraw from your account. So having some cash on the sidelines can make some sense. Gold and silver is useful if everything melts down, like it was maybe in North or South Vietnam back during the Vietnamese War to get out of the country, or Cambodia. It can buy you maybe safe passage out of the country. But this is insurance. I'm talking insurance. I'm talking something that you're going to put away in a safe and not expect any return on. It's not an investment. It's insurance, a sunk cost. And in this case, you don't want to own ETFs or mutual funds. You don't want to own gold in an IRA, because this isn't physical. You don't have that in your possession. For this to be catastrophe insurance, you must have it in your possession. So some, I don't know, probably not as much as 1%, 0.5%, 0.25%, I don't know what that number would be. But if you have parts of yourself that are really anxious, that want to protect yourself in this, the case of a collapse of the U.S., which in the short term is highly improbable, even in the moderate term, and it depends in the long term what you classify as long term, it can make some sense to have those physical items in your possession. So outside of that, you really need to make sure that your retirement funds, what you're going to count on for your income when you stop working, are held in financial instruments, because they by large have been the better investments. So again, it's important for us to sit with these difficult emotions that we have around the fear and the panic of the money scripts that are driving our actions. Because this dynamic is the same thing as with a stock market. And we've talked about this before, that when we see our stocks going down, we can panic and get out. We have immediate relief from the anxiety, but then the anxiety builds as we watch the market go up. It finally, we get convinced it's going to continue to go up. We get into the market, it goes up for a little bit, then turns around and goes down again. And this is called timing the market, right? Well, obviously selling out and going to gold is timing the market, right? We're convinced financial calamity is around the corner. I've seen this play out in so many ways, falling off the financial cliff. I think that was in 2012. I remember clients who were absolutely convinced that as of January 1, the market was going to tank. And fortunately, none of them got out. A lot of them were holding me accountable to what would happen. And in every case, stocks went up. They would have cost themselves thousands, tens of thousands, hundreds of thousands of dollars had they gotten out before that. So we've got to look at that. We've got to look at our confirmation bias. We've got to look at our fear of failing to be wrong, because sometimes when we buy into these theories, we so much want to believe them, and we fear, confirmation bias is we look for all of the evidence that would suggest we're right. All the evidence that suggests here's why the US dollar is going to nothing. And we reject considering the opposite. Why? I would suggest it's a huge fear of failure. It's a huge fear of saying I was wrong. It's a huge fear of acknowledging my fear has really cost me a lot of money. I have missed out on a huge run-up in stocks. And to admit that now will be painful, because I'm holding on to the hope that I was right and the stock market will go down, the dollar will go down, and I will be justified in the end. And that's what keeps a person hanging on to a loser. When you talk about timing stocks and investing in that manner, is we can tend to hold on to losers too long because of our confirmation bias and our fear of saying, I was wrong. Now, I am talking about individual stocks. I'm talking about a very specific undiversified investment. That is not the case of holding a diversified portfolio. A diversified portfolio by nature is not going to disappear, and there's not a pragmatic way to time a diversified portfolio. It'll go up and down, but it'll tend to go up more than it goes down. I'm talking about making these undiversified specific investments. So it's important that we understand what the emotions are that are driving us to make these decisions. And it's important that we learn to be with those emotions, honor them, understand that they have something to tell us. I think it was George Kinder that once taught me that pain is the bellwether, is it the bellwether of awakening? So it's important to listen to those emotions and not try to get rid of them. That's what buying the gold is doing. That's what selling out is doing. It's trying to resist and get rid of the emotion rather than embrace it and feel it and ask, what does it have to tell me? Thanks so much for joining me. I'll look forward to being with you next time.